So, there's multiple different types of investments, from short-term to long-term, from traditional to alternative. There's also many different vehicles to invest in, such as 401ks, stocks, NFTs, and real estate. So which investment vehicle is the best? That depends on many factors, such as your goals, risk tolerance, capital or money available, and time horizon. Personally, real estate is the best investment vehicle for me and my goals. Real estate is often ranked as one of the best investment types, and for good reason. Is real estate right for you? Let's break it down. Real estate is a tangible asset, which means you physically own something such as land, a building, or a home. This gives a more definitive sense of security and opens up the possibility of many different business models, such as rentals or flips. It's also possible to move into the property if all else fails and the business models don't work in your favor, making it a multi-use asset, as opposed to stocks or retirement accounts, which only serve to compound and grow money over time. Real estate is also not subject to total collapse the way stocks or crypto can be. Stocks and crypto could tank, dropping your net worth significantly and making it very undesirable to cash out on a downturn when most of your money has been lost, at least until the market recovers. Real estate values may tank, but rents tend to be much more stable, even during recessions. Real estate has the potential to cash flow, meaning it generates consistent monthly income through rents, as long as the property is managed efficiently. Rents also tend to rise along with inflation, boosting your returns in the long run, or the rents may be kept the same over time, pricing out other rentals in the area, guaranteeing your property will rarely face a vacancy. This will ensure consistent income for many years to come. Want to learn more about how to purchase income-producing real estate to replace your job? Click the link in the description below. The property may also be flipped and sold to a buyer through owner financing, securing consistent income until the loan is paid in full. This is done by buying a distressed property for a low price and renovating it, then putting it on the market for its newly assessed price after the renovations are complete. Then, instead of selling it to a buyer using a bank to finance the loan, you may choose to finance the loan for them and collect a monthly payment from them until the loan is paid in full, generating a new income stream and potentially helping someone purchase a home who may not have qualified for a traditional mortgage. Real estate historically appreciates in value over the long term, meaning the price of the property continues to increase year after year, even with market dips like recessions. For example, a property purchased today for $400,000 could be worth upwards of $800,000 in 20 years' time. Local factors such as job growth, urban development, and infrastructure can accelerate this. So understanding the market and knowing what the future holds in the area you plan on buying is important. Crime rates and rising property taxes, as well as other factors, can significantly slow down market value growth. So these are things to consider as well. You may also work towards value add-ons for your property in order to raise its assessed value. This basically means you upgrade and or renovate the property. This can be done by adding new paint and floors, replacing appliances, installing new windows and fences, or building additions, such as rooms, or increasing the size of the existing structure. If done right, investing $20,000 worth of upgrades into a property could raise its value by $50,000. The property could then be refinanced to cash out this equity, effectively making you an extra $30,000 in revenue, and the taxes can be deferred. More on that later. Another pro to investing in real estate is the power of leverage. You can buy a $400,000 property with a $15,000 down payment, yielding you the gains of a $400,000 investment with way less money down. Few other investments allow such effective leveraging. If you want to learn how to buy a profitable $400,000 property with only $15,000 down or less, click the link in the description below. Real estate also has good tax benefits, such as allowing you to depreciate the property over 29 years, even though the property is appreciating. This is because the property has a service life, so as time goes on and the property gets used up, the IRS lets you depreciate it year after year, even though the value of the property continues to rise. Real estate allows you to do a 1031 exchange, which lets you defer capital gains taxes by investing in other real estate. What this means is the money that comes from a property that is sold for a profit or refinanced to cash out on does not get taxed as long as that money is then used to invest in more real estate. So as for our earlier example, where we invested $20,000 to upgrade our property and raise the value by $50,000, if you cash out those $50,000 large, then reinvest it as a down payment on another property, you won't have to pay any tax on it. That's why so many of the wealthy dump their money into real estate. Taxes can keep being deferred and deferred to the point to where they're never paid, keeping more money in their pockets. Interest for mortgages and any expenses from the property are also deductible, while any large additions like fences can also be depreciated, just like the property as a whole, further expanding on the tax benefits of real estate. Real estate is also an inflation hedge, which is an investment designed to protect its value against the negative effects of inflation. Both property values and rents tend to rise with inflation, protecting your purchasing power and continuously making you wealthier in multiple ways. Fixed rate mortgages also become cheaper in real dollars over time. This is because as inflation rises, along with wages and rents, your principal and interest payment remain the same, making your mortgage cheaper year after year. However, your mortgage payment still increases every year because of yearly raises in insurance and property taxes, so expect some level of fluctuation even with fixed rate mortgages. With all that being said, real estate isn't always the best for everyone. There are still a lot of risks involved, and if proper measures are not taken against these risks, your business venture may end in disaster. Real estate is not very liquid, meaning quick access to your cash used in the property is not realistic. You can't sell a house in a day like you can sell stocks or crypto, making emergencies that require fast cash much more problematic. A way to mitigate this is having some emergency funds on the side, saved up in order to tackle any issues that might arise, protecting your investment from impulse sales due to financial crisis. Real estate management can be pesky, having to take care of tenants, repair and maintain the property, having to deal with vacancies and finding new tenants, and facing legal issues like lawsuits all require time and money to handle. One way to minimize these risks is by having a good tenant vetting process in place. Some of the things you should be looking for in a tenant are clean background checks, good credit scores, particularly payment history, good references, no prior evictions, and just a solid feeling of the person. Get to know your applicants when they go in to tour the property. You don't have to interview them all crazy, but you can usually figure out who's a good fit within a few minutes of meeting them. Trust your instincts. A good tenant is worth their weight in gold and will keep issues non-existent as long as you're putting in work on your end. You may also consider hiring a property manager to handle the day-to-day tasks for you, leaving less money in your pocket but more time on your schedule. Real estate has a decently high entry barrier, meaning you typically need significant upfront capital. I could open a brokerage account today and start investing in stocks for $1. Real estate, on the other hand, is not easily accessible to new or low capital investors, with the exception of REITs or real estate investment trusts, which function somewhat similarly to the way stocks do, but that's a whole other video on its own. A good way to overcome this obstacle is by purchasing a property as a primary residence in order to lower your down payment significantly. For example, if you purchase a $400,000 property as an investment using a conventional loan, you typically need 20% down, which equals to $80,000. But if you purchase the same property with an FHA loan instead as a primary residence, you'll only need 3.5% down, or $14,000 down. Way less money for the same asset. I teach you how to do this in my real estate course, link in the description below. Real estate may also be subject to downturns, such as the housing market crash of 2008, where property values plummeted to rock bottom. Local markets can also be very volatile and unstable, even if national trends are running strong. For example, if a big wildfire sets off in your area, housing values may drop while pretty much everywhere else in the nation continues to rise. A good way to minimize this risk is to be patient during the downturns. Do not panic and look to sell your investment as soon as possible, as you will ultimately lose a lot of money. Instead, hold on to your property, as values will eventually climb their way back up to normal levels and even surpass them. So when is real estate the best investment? Real estate is the best investment when you want long-term, stable income, either from rents or owner financing. You prefer tangible, physical assets with many more opportunities than just digital ones. You can efficiently manage your rentals, either yourself or with a good management company or staff. You want very high leverage with much lower interest rates. You can get good deals on underperforming property and add value to it, and you're looking to buy in a growing market with good fundamentals. Understand these principles of real estate and it will make you very wealthy. So are you ready to increase your income, stop working for money, and retire in 3 to 5 years instead of 50? Check the link in the description below. This will take you to my real estate masterclass, where I will teach you everything you need to know about purchasing and managing real estate to replace your income and stop working in 5 years. Real estate is not as difficult to get into or manage as you may think, and the risks can be minimized. That's why most millionaires in history earned their status using real estate and why we continue to use it today. Why wait when you could be living a life of freedom now? Click the link in the description below and change your life. Remember that investing to retire early is possible. You just have to put the work in.